Let's look at what is tax deducted at source or TDS. So, as per the Income Tax Act, we know that normal tax payment for one financial year is done on the next financial year. That is, the previous year income is assessed in the assessment year and we pay tax. A concept opposite to this is TDS and advance tax. That is, tax payment is done in the current year or in the previous year itself. Another difference is, normally tax is calculated on income. In the case of TDS or tax deducted at source, the tax is deducted while making payment for expenditures. TDS or tax deducted at source is income tax reduced from the money at the time of making specified payments. These specified payments can be payments for salary, payments for rent on building, land, furniture, payments for rent on plant, machinery or equipment, fees on professional or technical services, payment to contractors, etc. So now we know on these specified payments TDS is deducted. Who deducts the tax or who deducts the TDS? Any person making the payment to a third party is responsible for deducting the tax. Now, who are the parties involved in a TDS transaction? There is a deductor, that is a person making the payment is called the deductor, and there is a deductee, person receiving the payment is called the deductee. Let's look at an example. 50,000 rupees is paid as professional fees by A to B. So A is the deductor or the person making the payment and B is the deductee. 10% TDS is deductible in this case. Now A has to make a payment of rupees 50,000 to B for professional fees. While making this payment, A will reduce 10%, that is 5,000 rupees as TDS or tax and pay balance 45,000 to B. A will then pay this 5,000 rupees to the government on behalf of B. Now when B files his income tax return during the assessment year, he can claim the credit for rupees 5,000.